Life insurance and taxation. The session will review the content, clarify concepts. Understanding before and after tax dollars. The first concept to review is before and after tax dollars, as the discussion revolves around money. This is a concept many people find difficult to grasp. To put it simply, imagine your paycheck shows a top line of, say, $1,000, but the actual amount in your check is $700. That $700 is your after-tax dollars. However, when discussing investments, we must consider both before and after-tax dollars. After-tax dollars for premiums. Let's assume you want to invest $100, perhaps as a monthly premium for an insurance policy. If your average tax bracket is 30%, which is fairly consistent with the majority of the population in Canada, 30% of your gross income is gone before you ever see it, leaving you with 70% to spend. The question becomes, how much money do you need to earn at a gross level to have $100 left in your pocket for that premium? The calculation is straightforward. Take the $100 and divide it by the 70% you get to keep. This equals $142.85. Therefore, to pay a $100 premium, you need to earn $142.85. Before tax dollars and deductions. The second type of income is before tax dollars. This typically applies before deductions. If you can deduct the premium against your income, then you don't have to pay tax on that amount. For example, a $100 premium that is deductible is a real $100 before tax because you are deducting it. For life insurance, you are generally talking about after-tax dollars. The premium you pay for an insurance policy is always after-tax dollars, whether you're an individual policyholder or a company owning a policy on your life. The reason for this is so the benefit paid out to you or your beneficiary is tax-free. If a $500,000 policy was paid with before tax dollars, the death benefit could be taxable, and the last thing a beneficiary wants is a big tax bill. Group insurance and taxable benefit. With group insurance, the employer pays the premium and can deduct it from their expenses. However, the tricky part is that the premium amount will show up as a taxable benefit to you, the employee. When something is on your T4 as a taxable benefit, you are essentially paying for it yourself. This structure ensures that when you die and the death benefit, example $100,000, is paid out to your beneficiary, they receive the money tax-free. Capital Dividend Account, CDA. A very important notion in corporate planning is the Capital Dividend Account, CDA. This account applies only to Canadian-controlled private corporations, CCPC, not companies with stock traded on the TSX or New York Stock Exchange. The CDA is a notional account, meaning it is not a real bank account. It is only used when a capital dividend must be paid. There are a few sources of capital dividends, but the two examples you need to know are the non-taxable portion of capital gains. If you buy property for $100,000 and sell it for $500,000, you have a $400,000 capital gain. 50% of that gain, or $200,000, is tax-free and goes into the CDA. The other 50% is taxable. This money can then be paid out to the shareholders as tax-free dividends. Life insurance death benefits. If your CCPC owns and is the beneficiary of a life insurance policy, example a $1 million policy, and the adjusted cost base, ACB, the premiums paid over the years is $300,000. The ACB is always tax-free as it is a return of your own money. The excess amount is what goes into the CDA. In this example, the excess is $700,000, $1 million death benefit, $300,000 ACB. This $700,000 flows through the CDA and can then be paid out to shareholders as a totally tax-free dividend. For exam purposes, you need to know these two main sources: the non-taxable portion of a capital gain and the net value of a life insurance policy, death benefit minus ACB. Types of investment income. When it comes to non-registered money, not in a specific tax-sheltered account, in Canada, there are three types of income you can receive from your investments. 1. Interest. Interest is 100% included as income and is taxed at your marginal tax rate. There is no tax break whatsoever. 2. Dividends. Dividends receive preferential tax treatment under the Income Tax Act because they have a dividend tax credit. Unlike interest, the entire dividend is not taxed. You don't need to know the details of how they are taxed for this session, just that they receive preferential treatment. 3. Capital gains. Capital gains have a 50% inclusion rate. This means only 50% of the gain is taxed. The other 50% is tax-free. The portion that is taxed is called the taxable capital gain. Going back to the example of a $400,000 capital gain, $200,000 would be taxed at your marginal tax rate. Example, if you are in the 30% tax bracket, you would pay $60,000 to the CRA. The other $200,000 would go into the CDA tax-free. You must be familiar with both interest and capital gains. You can review this material in Volume 1, Life Insurance, and the 5th module, Taxation. Registered versus non-registered accounts. Registered accounts, pre-tax. Registered accounts are primarily for retirement purposes. The money invested in these accounts is considered pre-tax dollars. The main tax benefit is tax deferral on the principal and all income earned, interest, dividends, or capital gains. You defer paying tax until you take the money out in retirement. Examples of these retirement accounts are RRSPs, RIFs, LIFs, LIRAs, and RPPs. Once money is invested here, you don't receive T4S, T5S, or T3S, as it is all tax sheltered. Other plans offer a tax deferral on income only, meaning you cannot deduct the premium, but the growth is tax sheltered. Examples include RESPs and RDSPs. The TFSA, Tax-Free Savings Account, a relatively new plan since 2009, is another registered plan. The growth is not taxed immediately but deferred until you take the money out. Non-registered accounts, after tax. Non-registered money is always considered after-tax dollars. Capital loss and disposition. Capital loss: no one wants to lose money, but if you do, the Canadian government allows for an income tax break for a capital loss. Since capital gains receive preferential tax treatment, only 50% is income, capital losses are adjusted against capital gains in the same year. For example, if you have a $10 capital gain from one stock and a $10 loss from another, they offset and you have no tax to pay. Capital losses can be carried back 3 years to offset gains you made previously, which could result in a substantial tax refund. You can also carry these losses forward indefinitely. Importantly, on the day you die, all your accumulated capital losses can be brought forward against all income, not just capital gains, which is a benefit for your estate. Disposition. Disposition basically means when you sell or get rid of a property. Transfer to a non-spouse. If you own a cottage with an ACB cost of $100,000 and sell it for a fair market value of $400,000, you have an accrued capital gain of $300,000. The taxable capital gain is 50% of that, or $150,000. If your marginal tax rate is 40%, you would owe $60,000 in tax. If you give that property to your son, daughter, or anyone other than your spouse, you are still deemed to have disposed of the property at its fair market value. The tax is immediately triggered, and you, the father, would be charged the $60,000 in tax. Your son would receive the property with an ACB of $400,000. Spousal rollover. If you transfer ownership of the property to your spouse, there will be no taxation. This is called a spousal rollover. The tax will be deferred until the day your spouse also passes away. In a spousal rollover, your spouse receives the property at the same ACB that you purchased it at, which is $100,000. This is a key tax planning advantage for married couples, allowing tax deferral until the second spouse dies. Deemed disposition at death. When a person dies, they are deemed to have disposed of all their worldly property at its fair market value upon death. Death triggers a deemed disposition. Ottawa does a complete accounting, and all those deferred taxes must be paid at that time. Using the cottage example, if you were in a 50% tax bracket, your estate would have to pay $75,000 to the CRA, or the property may have to be sold. However, if it's a spousal situation, the spouse receives the property on a tax-deferred basis until the second death, when the taxes have to be paid. Capital gain exemptions. There are a few areas in Canada where you do not have to worry about capital gains. Principal residence. You are only allowed one principal residence per couple. If you own a house and a cottage, you must decide which one is your principal residence. The other will be an investment subject to capital gains. Lifetime capital gain exemption, CCPC/farm. Fishing. If you own a Canadian-controlled private corporation, CCPC, farm, or fishing property, you are allowed an indexed lifetime capital gain exemption, around $800,000, but currently over $833,000 on the capital gain. Life insurance death benefit. This is always tax-free because premiums are paid with after-tax dollars. TFSA. The money grows tax-free, and when you take it out, it is also tax-free. Windfalls. Lottery winnings, inheritances, and casino winnings are all tax-free. Estates and beneficiaries. Everyone has an estate. An estate is essentially anything that has your name on it, property and property rights after death. At death, you are deemed to have disposed of all property at fair market value. Estate taxes and creditors. Estates can be subject to probate, proving the will, and must pay a probate fee. Example, 1.5% of the estate value in Ontario. The estate must also pay all deferred capital gain taxes and satisfy all creditors, both secured, banks, credit cards, and unsecured. After taxes and creditors are paid, the remainder is distributed to the beneficiaries. Dying testate versus intestate. Testate, dying with a will. You decide how your estate is divided, and the province has no say. Intestate, dying without a will. Everyone has a will, either the one they made or the one the province makes for them. If you die intestate, the province steps in to divide the estate, which may not align with your preferences. Bypassing the estate. Proceeds from life insurance, RRSPs, RIFs, RPPs, and TFSAs are subject to taxation and creditors if you leave the estate as the beneficiary. To avoid this, you should name a beneficiary, preferred beneficiaries like your spouse, children, grandchildren, parents. A named beneficiary allows the proceeds to bypass the estate and creditors. If the estate is named, the creditors can claim the money. Things that bypass the estate. Property held in joint tenancy with the right of survivorship. Example, a joint bank account or house with your spouse. When one person dies, the other automatically steps into their shoes, allowing for the spousal rollover and tax deferral until the second death. Products with a named beneficiary other than the estate, life insurance, RRSPs, RIFs, RPPs, and TFSAs. Always advise your clients of the danger of naming the estate as the beneficiary. Insurance premiums and term insurance. Modal premium surcharge. Most people prefer to pay their insurance premiums monthly, as it is simple and painless. However, paying monthly incurs a modal premium surcharge. The formula for the annualized premium is annual premium times modal factor. For most companies, the modal factor for a monthly premium is 0.09. If your annual premium is $2,000, your monthly premium will be $2,000 times 0.09 is equal to $180. Multiplying $180 by 12 months, the annualized premium is $2,160. Meaning you pay a surcharge of $160 for the convenience of monthly payments. This is because the insurance company is essentially financing the annual premium. Universal Life, UL, is the only product that does not have a modal premium. For UL, you simply divide the annual premium by 12. This is because UL is predominantly an investment product that happens to have a term insurance rider. All other insurance products are true insurance products and have a modal premium. Term insurance. Term insurance is very popular, especially with younger people like millennials, because it is relatively inexpensive. They often need a great deal of coverage to cover high expenses like mortgages, but have limited income. The premium is calculated by looking at the cost of the insurance and multiplying it by the policy fee, which covers administration costs, commissions, underwriting, and profit. The main drawback of term insurance is that it has an expiry date. Example, term to age 65, term to 75, or a 20-year term. If the client dies within the term, the policy is paid. If they die after the term expires, there is no coverage. There are two main types of term policies. Level premium. The premium remains the same for the entire term. You pay a little more upfront than the actual cost of insurance, which creates a reserve to cover the higher cost of insurance later on as you age. This avoids the shock of a much higher premium later in life. This concept of a level premium is popular because people like to budget and know their costs ahead of time. Yearly renewable term, YRT. The premium goes up every single year. A common variation is a 10-year renewable term, where the premium goes up every 10 years. This can become prohibitively expensive later in life. With permanent insurance like term to 100 or whole life, the level concept means that although the actual cost of insurance continues to rise, the premium remains level because the insurance company uses the overpayments from the early years as a reserve to offset the higher future costs. Universal Life, UL policy features. Universal Life, UL, is a sophisticated product that is a combination of an investment component and life insurance. Policy structure. The client makes a deposit into an account value, like a bank account. From this account, the insurance company automatically deducts premium tax, 2–4% depending on the province. The cost of insurance, which can be a YRT or level cost of insurance. Policy fees and any riders. The balance of the deposit is then invested into the client's choice of funds, which can be conservative, GICs, daily interest, bonds, or higher risk, mutual funds, segregated funds. The UL policy acts as a shield. If the person dies prematurely, the insurance policy pays out. If they live, they have access to the investment account. The net amount at risk, NAAR, for the insurance company is the difference between the death benefit and the investment account value. For example, on a $500,000 death benefit, if the investment account holds $100,000, the insurance company is only at risk for $400,000. As the investment grows, the NAR decreases, reaching zero by age 100. Exempt versus non-exempt status. UL policies can be either exempt, tax-sheltered/tax deferred, or non-exempt, taxed every year. Policies acquired prior to December 2, 1982, are automatically grandfathered as exempt policies. Policies acquired on or after December 2, 1982, must pass a test to maintain their exempt status. Maintaining exempt status. A policy maintains its exempt status as long as the investment amount in the account value is equal to or less than the maximum taxable actuarial reserve, MTAR line. As long as the money is below this line, the growth will be tax deferred, and the client will not receive T3S or T5S. Losing exempt status. A policy loses its exempt status if the amount of money in the investment account goes above the MTAR line. Once it is above the line, it is considered an investment product, and Ottawa will require tax to be paid on an accrued basis. Remedies for non-exempt status. If a policy is in danger of going non-exempt, above the MTAR line, there are remedies the client can use to keep the tax-exempt status, which must be decided within 60 days of the policy anniversary. Increase the face amount. Insurance companies can automatically increase the face amount by up to 8% a year without medical evidence. This increases the MTAR line, giving the investment more room. Withdraw money. The client can withdraw the excess money and pay tax on it. Transfer to a side account. Fail-safe, all UL policies have a built-in side account. If the client doesn't respond to the 60-day notice, the insurance company will automatically transfer the excess money to this side account, where it will be taxable, but the main policy remains exempt. It is crucial to maintain the exemption status because if you lose it forever. Universal life death benefit options. Universal life is unique in that it offers 4 different death benefit options, and you must choose one at the time of underwriting. Level death benefit. Option 1, the beneficiary receives only the face amount. Example, $300,000. Level death benefit plus account value. Option 2, the beneficiary receives the face amount plus whatever cash is in the investment account. Example, $300,000 plus $60,000 equals $360,000. This is the most popular option and is very likely to appear on the exam. Level death benefit plus accumulated gross premium. Option 3, the beneficiary receives the face amount, and the policy owner, often a corporation, receives a return of premium, ROP. This is used predominantly by corporations insuring key people. Level death benefit plus indexing. Option for the death benefit is indexed to protect against the erosion of purchasing power due to inflation. Example, consumer price index or a fixed percentage. This is the most expensive option because the cost of insurance increases every year. Anti-dumping rule. The anti-dumping rule is in place to prevent the abuse of UL's tax sheltering privilege. This rule begins at the 10th anniversary of the policy. On the 10th anniversary, the insurance company looks back to year 7. They take the account value from year 7 and multiply it by 250%. This product is the maximum amount the client can deposit in the 10th year to stay exempt. If the client deposits more than this maximum, the excess will automatically be placed into the side account, taxable, to ensure the rest of the plan remains exempt. This test is done every year from the 10th year onwards, looking back 3 years each time. This is an important concept to remember for exam purposes. UL is the only plan that has this rule because it is the only plan that allows for additional deposits. Needs covered by life insurance. Life insurance covers both temporary and permanent needs. Temporary needs, covered by term insurance. Temporary needs are typically covered by term insurance, level term, 10-year term, term to 65/75, excreta. These needs are for a set period and require a lot of coverage for a small premium. Raising children during the dependency period. Children's education costs. Mortgages, car loans, and credit card debt. Term insurance is very popular with younger clients who have high debt and limited resources. Permanent needs, covered by permanent insurance. Permanent needs are those that never expire. They will be there until the day you die. These are covered by permanent insurance products. Funeral costs. Estate taxes, and paying off creditors/liabilities. Estate creation, leaving a legacy to a charity or loved ones. Estate equalization, example, giving the cottage to one child and an equivalent cash value from insurance to the others. Permanent insurance products are more suitable because most term insurance expires around age 75, which is often too early today. The 3 main permanent insurance products are term to 100, whole life, participating or non-participating, and universal life. Calculating insurance needs. One of the most legitimate questions a client will ask is, how much insurance do I actually need? While software can help, you should know how to do a manual calculation. Step 1. Settle the estate, cash needs. The first step is to determine the cash needed to settle the estate. This requires calculating a net worth statement, assets minus liabilities. Assets are what the client is willing to use to pay final expenses. If they want the home and cottage to stay in the family, those are excluded. Final expenses include funeral costs, example, $20,000. Taxes, example $160,000. Mortgage/debts, example $500,000 plus $30,000 equals $530,000. If the final expenses are $710,000 and the liquid assets available are only $283,000, there is a shortfall or cash need of $427,000. This is the base amount of insurance needed to clear the estate. Step 2. Income needs, capitalization. The second step is to determine the annual income shortfall and capitalize that amount. Survivor's annual income, the income the surviving spouse and net rental income, etc., continues to earn. Continuing expenses, the total annual expenses for the survivor and family. If the continuing income is less than the continuing expenses, you have a shortfall, example $7,600. You need an insurance fund that can generate that amount annually. You then capitalize the shortfall by dividing it by an assumed interest rate, the nominal rate. Capitalized value equals interest rate annual shortfall. Using a 6% interest rate, $7,600 divided by 0.06 is equal to $126,667. The total insurance needed is the cash need, $427,500, plus the capitalized value of income need, $126,667, for a grand total of $554,167. If the surviving spouse, example Mr. Jones, has more continued income than expenses, there is a surplus, and no capitalization is needed. The only insurance needed would be the cash need to settle the estate, $427,500. The estate tax portion remains the same regardless of who dies first. Impact of taxation and inflation. The question may be complicated by asking for an after-tax capitalization or a calculation that includes the inflation factor, the real interest rate. After-tax capitalization. If you're in a 30% tax bracket, you keep 70%. You must use the after-tax interest rate, example, 6% times 0.70 is equal to 4.2% for the capitalization. Real interest rate. The real interest rate is the nominal rate minus the inflation factor, example, 6% minus 2% inflation equals 4%. This is the most common variation on the exam. You will definitely get a question on the exam requiring you to figure out how much insurance a client needs. Insurance contract parties. There are several parties to an insurance contract. Insurer, the insurance company, the manufacturer. Insured, the owner of the contract/policyholder. If the insured and the life insured are the same person, it is personal insurance. If the insured, owner, and the life insured are different, example, a policy on your spouse or a key person, it is third-party insurance. Life insured, the person whose life is covered. Beneficiary, the person who receives the money. Contingent policy holder and beneficiary. To prevent the policy ownership or proceeds from falling into the estate, which is taxable and subject to creditors, it is always recommended to name a contingent beneficiary, secondary beneficiary, and, for third-party policies, a successor policyholder, contingent policyholder. Revocable versus irrevocable beneficiary. Revocable beneficiary. The owner of the contract has all control. They can change the beneficiary, borrow against the policy, cancel it, or modify it without notifying the beneficiary. A revocable beneficiary has no legal rights. In common law Canada, all provinces/territories except Quebec, the beneficiary is automatically revocable unless specified otherwise. Irrevocable beneficiary. The owner has moved their rights to the beneficiary. The irrevocable beneficiary must give permission for any change to the policy, including changing beneficiaries, canceling, or borrowing. This can be very difficult, especially in cases like a marital breakdown. In Quebec, civil law, the beneficiary is automatically irrevocable unless specified otherwise. Ownership of the contract. The contract can be owned by a natural person, you or me, a legal person, a corporation, or a trust. However, the life insured must always be a natural person. A child can be named as a beneficiary, but a minor cannot receive the money. The funds will be paid to a guardian, trustee, or public trustee and managed until the child reaches age 18, at which time the money will be released. It is generally not a good idea to name a minor as a beneficiary. Participating whole life dividends. Participating whole life policies are very popular today. The dividend is not guaranteed. On the policy anniversary, you will be notified of the dividend and asked what you want to do with it. There are 5 options for what to do with the dividend, all of which you need to know for the exam. Cash it in, receive a check for the dividend. Use it to pay the premium. Use the dividend to reduce or pay off the entire annual/monthly premium. Accumulate at interest. Invest the money with the insurance company to earn interest or put it into segregated funds/mutual funds. Additional paid-up insurance. APUI use the dividend as a single premium to buy more permanent insurance without medical evidence. This is the most popular option and the one most likely to be on the exam. The insurance increases year by year and is fully paid for, so you never lose that coverage. Buy one-year term insurance. Use the dividend to buy a one-year term policy equal to the cash value of the policy. This temporarily increases the total coverage for that year, but if no dividend is declared next year, the coverage returns to the base amount. Life insurance riders. Riders are optional benefits you can add to a policy to tailor it to a client's specific needs and budget. Paid-up additions. A rider for non-participating policies, like UL, that allows you to buy more insurance at your leisure, similar to the APUI option for participating policies. This is usually an exam question topic. Term insurance riders. You can add term insurance coverage, example, for $100,000, to a smaller permanent base policy, example $100,000, to give the client full coverage at a lower initial cost. Family rider/child rider. Insures the spouse and/or children. Guaranteed insurability benefit, GIB, rider. Allows the client to buy more insurance in the future without medical evidence. Every 3 years or so, an option comes up, and the client can buy an additional amount of insurance by simply paying the attained age premium. This is very useful for young people concerned about their future insurability or for parents insuring children. Accidental death and dismemberment, AD&D rider. Pays a benefit if the life insured dies or is dismembered due to an accident. The death or dismemberment must occur within 365 days of the incident for the rider to pay out. Waiver of premium rider, WOP, if the life insured becomes permanently disabled and unable to perform any duties. The insurance company will waive all future premiums after a 3-month waiting period. They will also reimburse the client for the 3 months of premiums they paid. This is a particularly good rider to have on term insurance. Underwriting and corporate insurance. Underwriting process. Underwriting is the process of assessing your insurability. The field underwriter, the agent, fills out the application, which is then sent to the company's underwriters. Possible outcomes include accepted at standard, policy issued at the regular rate. Accepted as rated, policy issued, but at a higher premium because the risk is higher. Issued with exclusions. Policy issued, but with exclusions for hazardous activities, like scuba diving or skydiving, or travel to war zones. Declined. Policy is not issued, and a reason is usually provided to the doctor. Preferred rates. Issued at a lower rate than standard for clients who are exceptionally healthy, non-smoker, healthy weight, etc. Underwriting tools. The tools used by underwriters to assess risk include Medical Information Bureau, MIB, the very first thing an insurance company does upon receiving an application. This bureau is checked to ensure the client is not being overinsured and to verify past claim information. Attending physician statement, APS, a report ordered from the client's doctor. Medical checkup, a full or paramedical checkup. Inspection report, verification that the information on the application is true. Motor vehicle report, MVR, checks for driving history. Police record/credit check can be ordered, as high debt is often seen as a bad risk. Corporate insurance. Group insurance. Group insurance is a third-party contract. Insurer, the insurance company. Plan sponsor, the employer, the insured, who gets the master contract. Group life insured, the employee, who gets a benefits booklet/certificate. It is generally basic term insurance. All group plans have a conversion option that allows an employee to convert the coverage to a private plan without medical evidence if they lose their job. This conversion must be done within 30 or 31 days of leaving employment. Key person insurance. Key person insurance is a policy owned by a company on the life of a vital individual. Premiums are not tax deductible. The benefit is tax-free for the corporation. For example, a corporation pays the non-deductible premium on a $500,000 policy for a key employee, and when the employee dies, the corporation receives the $500,000 tax-free. Buyout insurance. Buyout insurance is used by partners to ensure that if one of them dies, the surviving partner has the money to buy the deceased shares. Crisscross arrangement. Each partner buys a policy on the other's life and pays the premium. When one partner dies, the insurance company pays the surviving partner. The survivor uses the cash to buy the shares from the deceased's estate. The survivor now owns the entire company. Share redemption. The corporation owns the policies on both partners' lives and pays the premiums. When one partner dies, the insurance company pays the corporation. The corporation then uses the funds, flowing through the capital dividend account, to buy the shares from the deceased's estate. The shares are handed back to the corporation. The remaining partner now owns everything. You need to know both of these arrangements for the exam. Joint last to die term to 100 is the favored product for estate issues.